Again, thank you all for joining us today. We're going to be discussing valuation and volume trends amid COVID-19 for M&D private equity deals. This is Opus Connect's last webinar of the year. It has been quite the year, but we appreciate you all joining us for this last go around, and be sure there will be more in 2021. For those of you I have not met, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We're a lower middle and middle market M&A focused organization. We are membership based. The way we do things is of course changing given the new climate. We're excited to introduce all of that to you in the coming weeks. But for now, if you want to learn a little bit more about what we do, the different deal connects that we put on, many of you are participating in today, feel free to reach out to my colleague, Jacob Zephyrin. His contact information is below. We'd be happy to answer any questions you might have. Today, our panel will be taking live Q&A. So as questions pop up, please don't use the chat function, use the Q&A bubble at the bottom of your screen. Go ahead and submit your questions there. And John, our moderator, will try to get to as many as possible. These events would be tough without the support of our sponsors. So I definitely want to give each of them an opportunity to say a few words. We'll shift to the next slide here. I don't know if Steve Finder is in here. I don't believe he is, but we'll acknowledge him. Let's go to the next slide, please. We might be having, okay, great. Before IPO, I want to acknowledge Steve Finder Focus Search Partners. They've been a partner all year long. They do executive search for PE firms. So if you want to learn more, please reach out. IPO, I believe Crystal, no, sorry, Craig is not in here. Hopefully you'll hear from Craig later. We'll move on to the next slide though. And McDonald Hopkins, Jason. Jason Klein, go ahead and introduce yourself and your firm, please.
Yeah, good morning. My name is Jason Klein, and I am a partner at the M&A group at McDonald Hopkins. My colleague, Crystal Contini, is also here, and she's a partner and co-chair of the group. We are a full-service law firm based out of the Midwest with offices in Ohio, Illinois, Michigan, and Florida, with around 140 attorneys. Crystal and I specialize in representing both sponsors and sellers in the lower middle market, mainly in the manufacturing, industrial, healthcare, business services, and construction industries, with an enterprise value in the $10 to $90 million range. But we also work on deals as low as $1 million and over $100 million. Thanks.
Thank you, Jason, and welcome to you and Crystal. Thank you. Plante, Moran, John O'Connor is going to be moderating today, so we'd like to acknowledge them, but we'll wait so John can introduce himself once we get to that place. We do have 2 poll questions that we'd like to ask of you all, so we're going to go ahead and launch those. We'll shift to the next slide here. We'd like to know who you are, so let us know. We're going to launch this box here. Go ahead and submit your answers: independent sponsor, investment banker, capital provider on the debt or the equity side, service provider or other. Let us know, and we'll move on shortly. You are joining us now. Okay. So 16% independent sponsor, 32% investment bankers, some capital providers on the debt side, mainly the equity side at 16%, and some of our sponsors and other. Thank you guys for participating there. I have one more question that I'd like to ask, and this is around when you're going to feel comfortable joining in-person events. Now, after January, we know we have a vaccine, but maybe not until you get it, or never. You didn't ever like it anyway, and you want to continue on virtually. Let us know. We'll give it 20 seconds, and then we'll get to the good part. Okay, so 7% of you are good now, 33% post-January, and most of you, 56%, not until you get the vaccine, understand, and 4% of you are good right where you are. Awesome. thank you guys for participating in that. Without further ado, I would like to introduce today's moderator, John O'Connor of Plante Moran. John, the floor is yours, sir. Take it away.
Thanks, Lena. Thanks. Glad to be here today. My name's John O'Connor. I'm a partner in our private equity practice of Plante Moran. I'm headquartered out of a Chicago office. I'm currently at my home on the north side of Chicago, just a stone's throw from Wrigley Field. Plante Moran itself is a middle market accounting and consulting firm. So we go back almost 100 years at this point. We have about 3,300 professionals. We serve over 1,500 private equity funds and portfolio companies. I lead the private equity practice from Chicago. We have about 25 offices, both domestically and internationally. From an overall service perspective within our private equity space, we help clients assess the deals, mostly working with private equity through the due diligence, both commercial, financial, IT due diligence. We help them close the deals. And then during the holding period, we help grow with EBITDA improvements and alpha, and along with audit and tax from a compliance perspective. And we're always thinking towards an eye on sale readiness. So we're always thinking about helping our private equity clients and management build value during the process. So very happy to be here today. And I would like to introduce the panel and give them an opportunity to give them a couple minutes just to talk about themselves, starting with Brandon, Chris, Jessica, and John. But Brandon, we'll go to you if that's okay, and give us a few minutes on yourself and Aterian.
Sure. Thank you, John. My name is Brandon Bethea. I'm one of the 3 partners and co-founders of Aterian Investment Partners. We're headquartered in New York City. We're a lower middle market special situations fund. We're on our 3rd fund at present, which is a $350 million fund, and invest across industries, healthcare included. We're principally a control investor and focused on industrial and industrial services for the most part.
Excellent. Chris, you're next.
All right. Well, thank you. And it's great to be here today and to sit on this panel. And I'm looking forward to meeting a lot of you afterwards in the one-on-ones. My name is Chris Lund. I'm a partner at Hamilton Robinson Capital Partners. I've been at the firm for 18 years now. Our firm was founded in 1984, and we have had a focus since then on industrial companies. So this conference is very relevant for us. We define the industrial world as manufacturing businesses, or we also invest in industrial service companies. Currently, I sit on the board of 3 of our companies. And I should also mention that we look for situations where we can be the first institutional capital into these companies. So that means buying a lot of family-owned businesses or corporate carve-outs. It's not uncommon that our investments, while we are control investors, that the founder or family retains an interest in the business going forward. I'd like to say that this is a challenging and different time, but it's great to be here, and we're pretty excited about what we're seeing in the market.
Excellent. Thanks, Chris. Jessica Ginsberg, please.
Yes, good morning, and thanks, John. I am a director at LFM Capital. We are a Nashville, Tennessee-based lower middle market private equity firm. We are focused on manufacturing and manufacturing only. So this conference and this panel is really right up our alley. We were founded by engineers and former operators who, really kind of grew up on a shop floor. They know what a manufacturing facility should look like, feel like, smell like, and love to live it and breathe it every day. We were founded in 2014. We're investing out of our 2nd fund, which is $185 million, and typically look for companies in the lower middle market, 3 to 15 million in EBITDA. And we look for situations where we can add value based on who we know, what we know, and where we've been. Tend to be really flexible around management, like to sort of, work with management, whether it's toward a transition out of the business or helping take the business to the next level. It's us.
Thanks, Jessica. John Slater, Focus Investment.
Good morning. Thank you, John. Yes, as you said, I'm John Slater. I'm the team leader and Focus's advanced manufacturing and automation team. Focus itself is a US-based middle market investment bank. We're headquartered in the Washington, D.C. area near Tyson's Corner. We are a distributed organization. I'm actually located in Memphis, Tennessee, but our team has members in Cincinnati, Ohio, and Bend, Oregon, and Los Angeles, and Pittsburgh. Our practice is actually global through our membership in a group called M&A Worldwide, where my colleague, some of you know, Jorge Maceras, is the group leader for advanced manufacturing and organization there. We focus on manufacturing, obviously, in general, but our specific concentration has recently been in what we call service manufacturing or manufacturing services. What used to be contract manufacturing, our distinction is we like to deal with guys who have really nice margins. Spoiler alert, we have now closed as a team 7 transactions this year and with one more scheduled to close in our advanced manufacturing team. So we look forward to speaking to everybody throughout the day. But we're going to give a pretty positive message as we get into the discussion.
Excellent. Wow, that's great to hear. Great to hear. So there is a field, we have a lot of material to cover, and we may not get to a lot of the items that we would like to get to, but there's still a lot to cover. And if you have questions specifically to the audience, please feel free to submit them into the little Q&A field, and we'll address it as time permits. But maybe just initially kind of circulate through the panel again. COVID, as we all know, has affected every company and in every industry in different ways. When you look to what's of interest to you now in 2020 and think about it in terms of the sustainability post-COVID, what industries are you most focused in? And maybe we'll start with Brandon to give some thoughts initially and then circulate through the group. What specific industries would you be most focused in at this point in time based on the expectation of sustainability? And then what others might you just want to stay away from because it just doesn't feel right given where we might be going in the new world? Brandon, you want to start with that?
Sure. I mean, as I mentioned, we're a special situations firm, so we're not organized by industry, but we certainly try to tease out trends and things that we've experienced in our own portfolio over time. We're currently looking for investments that are in warehouse fulfillment within e-tailing and Amazon. That can be both manufactured products that go into those buildings, that can be tradesmen that might put in air conditioning systems, all those sorts of things. But if you believe that people are going to buy more stuff online, then you're going to need more distribution centers to fulfill that. Within healthcare in particular, we're focused on what we think is going to be the ultimate long-term win here. I know obviously recently ICU has been an area of emphasis and operating rooms have been de-emphasized because they needed the capacity. We're investing in businesses that are oriented towards the operating room, which we think over the next 3 to 10 years will be the highest growth area, and in particular robotic surgery and radiation oncology. We've made those investments through our platform investment, Vanderbilt Manufacturing, which is based in San Jose.
Excellent. Chris, how about you? What are you looking at in terms of items of interest and areas you may want to shy away from at this point?
Sure. So our focus throughout our portfolio, and this is pre-COVID, during COVID, has been on technical products or technical services. So a lot of our companies produce products that have a high degree of engineering content. Either it's a very technical component that goes into a larger product, or it's more often a technical system, an engineered system. It was interesting to hear your comment, Brandon, on warehouse fulfillment. We're currently under letter of intent with a business that provides conveying systems in warehouses for fulfillment. So we like that trend as well. But we've been very pleased. Our portfolio has performed quite well during COVID, and we think it's because of our focus on these engineered technical products, because they tend to really be more of a certainly a B2B sale. That's driving the end demand, and they also they don't have the commodity aspect to it as well. So from what we stay away from, certainly anything really driven by I guess in-person type of retail performance versus an online.
Yeah, excellent. Thanks, Chris. Jessica, maybe you want to share your views on key areas versus areas you shy away from?
Sure, of course. So like Chris, we're very focused on highly engineered products that aren't commodities, that are differentiated in the market, usually where there's some special sauce, either in what the product is, how it comes to market, something like that. So I think, our focus has always been and will stay, right there in manufacturing. I think we tend to keep our scope pretty broad within that manufacturing umbrella. What's been really interesting for us over these last several months is this downturn environment that we're living in right now is so different from the last one that we experienced in 08 and 09. And so I think certain areas of the market that we have shied away from historically, oil and gas, auto, building products, some of those sort of black eye segments are kind of coming to surface again. And I think we're realizing that, not all downturns, not all recessionary environments are created equal. And, we've seen building products explode. We've seen a lot of interesting deals in building products that I think in past we would have tossed aside. And now we're saying, maybe some of these things are worth digging into. So it's definitely made us, rethink some things. I think in terms of key areas where we're focusing, industrial automation is a big one for us. That was, that's a great segment pre-COVID, but I think coming out of COVID, as we think about fewer people in tight spaces, it makes a lot of room for, robotics and automation. And we have a portfolio company, Eckhart, that plays in that space, but we're actively looking for others. I think defense is also an area that, we've seen a lot of activity. We own a business called J&E Precision that manufactures precision components for aerospace and defense. And we've been really active on add-ons there through this time. So I think certainly it's been an interesting market, but there's a lot to keep digging into.
Yeah, excellent. Thanks for that. So John, maybe just add, put the same question to you, but maybe add just a couple things, like what might you be seeing in terms of adjustments, impact on run rates, how that impacts valuation. I think we are seeing, everyone in the group seems to be interested in automation and technology and robotics. So, we're seeing that across the board, but industries of focus, John, and then maybe your views on adjustments.
So, and then I would say basically we're looking for companies we can sell to, Chris and Jessica and maybe Brandon. We the deals that we close this year tend to be, and we do a lot in precision machining right now because we see that as an industry that's in a really dramatic period of consolidation. Obviously, we like working in industries where the companies are owned by entrepreneurs. That theme of engineered services. We basically work with companies that solve somewhere in the supply chain, solve a need that a product owner or manufacturer has for components or assemblies or parts, and they're generally what's being sold is engineering services, the knowledge that helps somebody design a part better or manufacture a part better, generally pretty sophisticated stuff. that's the core of U.S. manufacturing. The themes that we're focused on are these days are reshoring, which we hear more and more. There's going to be reinvestment in at least the high end of North American manufacturing. We pretty strongly believe that. I think that there are a couple of other, we're hearing more and more about industrial services. We've got another team that focuses in that area, and we're seeing quite a lot of activity in industrial services and also in supply chain. We've got another team that focuses on supply chain distribution. So valuation, our answer is very simple. Forget about 2020. You're going to price your deal based on 2021, guys. And obviously, we do spend a lot of time trying to work on recasting, trying to explain. We've got a current deal in the market, Project Orbit, where the company, basically we're going to market with 2/3 of the EBITDA that we thought we would have when we were first hired. But the company is clearly a much better company than, its 2020 performance, even though that performance is quite good. We, in terms of what we see out there, and I know the other panelists don't want to hear this, we've got, in that deal, which is a little under $10 million revenue company with close to not quite 30% EBITDA margins. We've now got 75 books out in 2 weeks. So that'll give you a little feel. There's a lot of money out there. So we're basically believe that the market is willing to look past, what happened in 2020, so long as there's clear evidence that the revenue is coming back, that the orders are there, they just got delayed, which is what we typically see, at least in our key sectors, aerospace and defense, medical device, automation, it's there.
Yeah. I mean, it feels that way, and I would just open that up for any rebuttal comments to the group. Tossing 20 and focusing on 21 in the areas of automation and robotics seems to be a reasonable position. But Jessica or Chris, do you any feedback, comments on that?
Yeah, I mean, I think it's tough to completely ignore it. I think that, when you see businesses that performed really well through 2020 and through all this madness, I think that is certainly, a check mark in the pro column. I think when you have businesses that experience delays or, you name it, had to close for a certain period of time, I think that you really need to look at each on a case-by-case basis. I mean, we really pride ourselves here on being flexible, on, not sort of slapping the same process on every deal. And so I think you really need to dig in and understand the customer dynamics, understand, what happened and sort of what backlog is going forward. So I think you have to be level-headed about it. And I think that based on our experience, the banker community is really appreciative of, our ability to just take that level-headed approach.
Yep. Chris, did you want to add something?
Yeah, I mean, I would completely agree with what Jessica said. I'd say the main point that I'd add is businesses that have performed well, and I mean, businesses that have grown in both revenues and earnings during COVID on an unadjusted basis, are certainly trading at a significant premium, and they're going like hotcakes. Frankly, it's hard to keep up with them. But I would agree with both John and Jessica. Looking forward to next year, we're spending a lot of time digging into the backlogs, the timing of that, understanding in 2021. Okay, orders were delayed. Well, when are they going to show up again? And I agree. You need to really work through those details in order to invest today.
Yeah. Excellent. Thanks.
So if I could add one thing, John.
Go ahead, John.
As an example, we had a buy-side assignment earlier this year. These are a very, very sophisticated medical device target that we had found for our client. The deal, was supposed to close March 30th. It was canceled on March 28th. We ended up, though, our client, got comfortable that the world hadn't ended. We went back to the seller, and then on, I think it was July, sometime early July, we closed at the same price, even though actually, performance was probably down, maybe as much as 25% from the highest projections we were working on, but it's worked out extraordinarily well, for our client, because they were able to just slide right in and get some new orders, and it's going to work.
Thanks, John. Maybe I could shift gears for a second just to the diligence process. And for Jessica and Brandon, since I know you spent some time on the shop floors, this whole notion of, this event today is virtual, of course, and so many PE funds and meetings are happening virtually, and the diligence around virtual diligence and maybe getting an understanding of what the shop floor is like if you don't have an opportunity to visit it live. We feel that our clients are pretty open to us doing things remotely and having, videos, cameras set up to get an understanding of what's happening and actually meeting the management team. But maybe Jessica, I'll start with you. What's your feeling on visiting the floor and seeing the floor virtually versus doing a physical walkthrough?
Sure. So, I would say at first, early days, of COVID, call it late March, April, I think our team was pretty skeptical about the whole concept of a virtual management meeting. How much can you really get done if you're not actually sitting across the table from people? But, sure enough, we made that pivot, and I think we were pleasantly surprised at just how much, you could get out of it. I think we would say probably, 75-80% of an in-person management meeting you can get virtually. Now that last 20-25% is pretty important. We have participated in meetings where they have done, shop floor tours and even drones and things like that. And that's fine. We will never close a deal without, having been in the facility. I think that's just in our DNA. We've got to see it and touch it and really, just live through our own eyes. Now we have, and I could see us continuing to get pretty far through a diligence process before a visit. We actually closed a new platform in September, and it was it's a business called Diama Brush. They manufacture consumable used in.
You guys there? Did we lose Jessica?
Yeah, we might have lost her for a moment.
She's coming back. Well, maybe until she comes back, Brendan, we'll shift over to you if that's okay in terms of virtual diligence versus live.
Yeah, look, I don't have much to add to what Jessica offered me. For us, there is a schmuck factor involved of actually just going to the plant and making sure the assets are really there, right? So we've structured our plant visits towards the end. It is important to see how a business is managed, and touch it and feel it is pretty critical. I would say, the impact that we've noticed, we closed one deal during COVID that started after all the shutdowns were put into place and finished, in the fall. And not having that soak time with the sellers, this is a family founder business that we bought as an add-on, and not having that soak time of dinners and lunches and just an ability to develop a relationship like you normally would, person to person. That impacts when you get to the end, topics in the purchase agreement or just working through wrinkles and diligence, right? It's not as fluid as it would normally be. So that deal probably took a month longer than it might have in a normal environment, just because you're finding new and different ways to work through issues, whereas before you'd have a personal relationship that you've been able to develop, to rely upon as those things pop up. So that's our principal notice, but we still go to the plant, need to see it.
Okay, yep, all good. Maybe I'll open this up to Chris and John. I'm going to blend a question that came in from the audience about the ability for private equity to make manufacturing business improvements, and how COVID has changed. So has COVID changed the way private equity can make improvements in a company's manufacturing process, especially maybe with limitations around seeing what's actually there, and assessing where the opportunities for improvement are. And John or Chris, maybe I'll start with you on that and then move to John afterwards.
Sure. Well, one of our big operational improvement focuses at these companies is applying lean, just, looking at manufacturing processes, making them more efficient, taking the waste out. And I'm happy to say that's continued during COVID. All our businesses are essential businesses, so they've remained open. And so while sure there have been some delays, I'm pleased to say that progress has continued. We've been able to hire. It's a great time to hire some people. There are some great manufacturing, lean folks, sales folks, what have you, that have been displaced as a result of COVID. So we've been able to really make some nice improvements on the human capital side as well.
Excellent. So John, maybe I'll shift over to you on the similar question. Do you see opportunities where PE can come in and identify areas of improvement, maybe add to it a little bit, not just within the four walls of the facility, but maybe throughout the supply chain as well? Do you see COVID as being an impediment to that, or something that can be enhanced through private equity investment?
COVID has made it absolutely necessary. So we've actually got a buy side in the industrial automation integration space, a company that focuses on the digital side, things like PLM, product lifecycle management, manufacturing execution systems. Their business is booming. They're actually sort of desperate to find some great engineering shops that can add to what they're doing. And again, the virtualizing of the supply chain we've thought it was the future all along, but suddenly with COVID, it's an absolute necessity to be able to track everything across the whole delivery cycle. And I think, private equity, it's not just, private equity doesn't work if all it's doing is financial stuff. It's got to make the operation more efficient. Most of the companies we work with, they're all really smart entrepreneurs, but their ability to introduce this digital sophistication is limited. They just don't have the teams. So Chris, I assume you guys are certainly probably into, backing up your portfolio companies and making those enhancements.
Well, Jessica, welcome back. It's good to see you again.
Our office just lost power, and we're back now. So sorry, everyone.
Well, it's good to have you back. Maybe we'll shift gears again and talk about fund level considerations. So, and Jessica, maybe to welcome you back, we'll start off with you on this one. But maybe from an investment perspective, structuring, controlling versus non-controlling, how you might structure a deal differently in COVID from where you may have done it pre-COVID, or what do you anticipate post-COVID?
Sure. So I would say first, and this is echoing something Chris said a little earlier, companies that performed well through COVID, valuations are holding up immensely. I even think that there's sort of a scarcity premium, and those businesses are trading for even higher than they might have traded pre-COVID. I would say, more generally, we are seeing a lot more openness to structure in deals. So earnouts, seller notes, things like that I would tell you in 2019 just never would have been competitive. But I think you have owners that are ready to take some chips off the table, and they have a lot of confidence in their businesses, but also might not want to live through the nightmare of through. And so they're saying, okay, I believe in it, but I'll share the risk. So let's structure an earnout as part of this transaction. We are hearing of a lot more minority deals. We typically, only do control. Would be open to a minority deal for the right situation, but it's not sort of, what we consider our kind of bread and butter. I think overall, though, at a high level, valuations are holding up pretty to where they were before. It just might not be all cash.
Very good. Brendan, you want to share any from a structuring perspective, how you view kind of maybe how things have changed during COVID?
No, I mean, I think Jessica hit it. You know, there was like a 4 to 6 week burp there where you could do kind of some interesting things. And since then, you know, the market is back, and a lot of middle market lending is in fund structures now. And there's a lot of private equity money out there. And those are structures that don't let you take two years off. So people are active and they're busy and they're out there. And so valuations are back. I mean, one thing I've noticed in some of our deals is whether it's an earnout, but in our case, we've seen sellers be more open to rolling some of their proceeds into a pro forma deal, especially if their earnings have been impacted in 2020. They want to get some value now, but they also believe in their recovery, and a rolled stake is a way for them to participate in that. But you know, similar to Jessica, we're control investors, so we're not as active on some of those other structured type deals.
Okay, Chris, from Hamilton's perspective, any
Yeah.
of the structure?
I think the only thing I'd add is, well, I guess two concepts. One, it's getting back to how many ad backs there are and how aggressive those ad backs are, how creative John gets late at night thinking these things up. And in the cases where it is heavy ad back, that is where we are definitely seeing some structure, maybe a contingent note, maybe an earnout. And then that to us really speaks to the seller's confidence in these ad backs, if they're really buying into them. You know, that said, the only other structural element that we've noticed is there's a lot more equity going into these deals.
Mm-hmm.
Buyers just if they do get comfortable, it's so competitive because it's just you know, thin out there in terms of deal flow that when people do get comfortable and get aggressive, we're seeing a lot more equity.
Yeah.
So John, I've got a question for the PE folks here. Are y'all seeing any differences in seller motivation? Now, obviously, if the owner's 70 years old and ready to retire, that's one thing. But I'm talking about the younger management that isn't necessarily ready to hang it up. Do you see more willingness, for folks to bring in backers than pre-COVID?
I'll comment there, John, to kick things off. You know, one thing we've seen that the case with smaller companies and add-ons. So we've closed on 3 add-ons during COVID, and I think some of these managers, regardless of age, just want to be part of a bigger company if they're leading a small company during COVID, just to have more resources. So that's something that we've seen.
Brendan?
We're actually, you know, seeing a lot of behavior change on the buyer side, you know, and it's interesting to watch. But Jessica mentioned earlier that companies that have done well, you know, they're going for a premium perhaps. What we've noticed, it's permeated even into our sort of special situations, somewhat slightly hairy deals where private equity firms earlier on in the process will dedicate larger chunks of their team to accelerate diligence to try to steer a deal their way. And so even in our types of deals, which aren't 10, 12, 14 times EBITDA purchase multiples, you have to decide pretty quickly as a firm, are we going to dedicate resource here or not? And if you're dedicating resource, it's like a full attack mode type situation. And even then, we're running into situations where you do all of that work. And if someone believes they have a thesis or believes they have an angle, they're willing to push it a half turn, put it in with equity, as Chris said, put in a half turn or 3/4 turn to win that deal. And that was not necessarily quite as prevalent 2 years ago, but it is the way that the market is functioning today.
Speaking of new things in the market, one thing we're seeing tonight, it was interesting when Lena showed who the attendees are. We've got a lot of attendees, who are, call themselves search funds or independent sponsors. And we're actually, for the first time, talking to a lot of folks who say they're search funds, whatever the term is, who actually appear to have pretty solid stories. Folks who came out of a big company have, some of their own money and some real backing, or at least appear to. So I'm curious if others are running into, and they all say they can go to you guys and y'all will back them in a deal. So I'm curious as to the private equity reaction to that.
Jessica or Chris or Brandon?
I mean,
Go ahead, Chris.
no, go ahead, Jessica, please.
I was just going to say, I mean, we certainly hear from independent sponsors and search funds more than we used to. I don't know that it's been impacted by COVID so much as, more people just kind of going out and hanging their own shingle and finding deals, and then realizing that, they gotta find people with funds to back them. We've spent time on a few independent sponsor deals where we've, dug in and tried to kind of, get some, really get into the process and be competitive. I think where we struggle sometimes is figuring out, one, the economics, and two, we're an operationally focused firm, and a lot of times, these independent sponsors, are also sort of approaching a deal from an operational perspective. And so, it just creates some challenge into kind of, okay, well, whose operational plan, reigns supreme, and then how do you kind of get everything all aligned?
Good. All right, thanks for that. I want to get to another question that came in from the audience, and I'd invite any other questions from the audience. If there's, if you have any, feel free to enter them into the field. But this is more of a holding period question. Are there any different ways that you're evaluating and managing the portfolio remotely now, like things like shop floor cameras, access to the ERP systems, different types of reporting? Are you doing anything differently in this COVID remote virtual world that you may not have done prior in order to manage the performance of the portfolio holdings? Chris, if I start with you on that one, if that's okay.
Sure. I mean, no, we haven't installed cameras on our factory floors, nothing like that. But we're doing a lot of this, a lot of Zooms, talking. We always talk to our CEOs frequently, but we historically used to like to visit our companies frequently. We're not the firm that just shows up for the board meetings. That's been replaced by Zoom during this time.
Mm-hmm.
We're just trying to increase communication, and really just try to be there for our managers. But beyond that, nothing specific.
Jessica, are you doing anything differently during COVID?
Yeah, so I would say, COVID has really accelerated some of the, plans that we kind of had in our back pocket. We've been pretty actively implementing tools like Power BI, with our various portfolio companies, just so that we can get more up-to-date, more real-time data. And it's just helped us to, we think, do a better job of forecasting. While we're operationally focused, we're not running our companies day to day, but we are, very active at a strategic level. And so when COVID first kind of hit in the spring, we amped up the communication big time, definitely much more video than we ever did before. And then, that communication has sort of, reformatted our Monday meetings a little bit, just as, we're taking a deeper dive on a frequent basis into our businesses. And so I think for a younger firm like we are, who has never really lived through a, real recession, I think for us, it's been a real development opportunity.
Yeah. Brandon, if there's anything else you want to add from monitoring performance remotely?
No, we haven't changed the way we engage with our portfolio companies. We felt good about where that process was. What we did do, we put in place Zoom calls basically on every other week, and at least initially, with all the HR directors and all the CEOs and the firm, and made sure that we were exchanging best practices and had a data site set up for COVID management, basically. And then as that's played out, we used to do a once a year in-person CEO summit, and we've replaced that with every 6 weeks, we'll do a Zoom call, we'll have a specific topic, we'll bring in, maybe we'll bring in someone from Plante Moran on merger integration, or maybe the topic is predictive analytics, or maybe the topic is something else. It's something that they're interested in doing. And then the one thing about the Zoom technology, which we found interesting, is those breakout rooms. You can have pretty good conversations that way. And so we've tried to, that was something that we were going to aim for in the future, but this has brought it forward for us to really try to have shared practices across the portfolio in a way that is hopefully better than what we were doing in the past.
Excellent.
I should have mentioned that we're doing something similar. We call it a CEO forum. I mean, initially it was every week, really more tactical about finding the right PPE and what have you. And now the cadence is really more monthly, sometimes twice a month. And the topic's still, trying to be a resource for COVID, but then, recently it can be any topic. For example, hiring safely in states that have legalized marijuana. How do you deal with that in manufacturing environment, that type of, which was pretty interesting. Fortunately, we don't have a good answer yet, but we're working on it. But yeah, I mean the Zoom, and that's Brandon. I'm going to try the breakout room concept. We have not employed that yet, but that sounds very very creative. I like that.
I think that's one thing I've seen across the board within our clients is more collaboration amongst the portfolio companies, more group CEO meetings, more group CFO meetings, just to share stories and to leverage best practices around that. So we've talked about the manufacturing companies themselves. We've talked about structuring. We've talked about holding period monitoring. Maybe we just shift back to the diligence process a little bit. Maybe just talk about what you're seeing in terms of diligence. And John, maybe I'll start with you, if that's okay. The diligence process, we're in the midst of what will be one of the busiest quarters in our firm history in terms of Q&A and due diligence projects. And, obviously they're all done remotely, but John, maybe you could share.
I think we're seeing huge amount of Q&A, even in pretty small deals. Our data rooms are becoming, awfully robust. And fortunately, I've got some folks on the team that are able to spend their life populating data rooms. And I think there is more use of outside advisors, either accounting firms or specialist Q&A firms. I definitely see that. And I think, the COVID clearly has an impact. I mean, you've got to wonder, if you don't spend a lot of time physically in the business, what secrets are hidden in that back room that you don't know about. And, we encourage our clients to be open. I mean, our whole philosophy is, if you got a skeleton, it's going to get found out. Let it get found out before we sign that LOI. And, we don't want deals renegotiated because of something, it's predictable. But deals take forever now. There's no question about it. They take far too long.
Brandon, you made a few comments about predictive analytics and data analysis. Are you seeing more data scrub in the course of the due diligence process?
I mean, look, I think from our perspective, what we're really focused on, and we were focused on this before, but it's a heightened area of concern now, is customer relationships and market orientations. And you're going through a period where there'll be demand shifts within the economy as a result of this. Just behavior is going to change. How does that impact your existing relationships, and for your customers? How does it impact them? And is that going to be a strong company going forward, or not a strong company? Those are areas where we've really tried to polish up and invest more on a diligence basis, because that's sort of the key to it all. On the data side, we're trying to get better at that. I would say, just looking around and talking with people in the space, I still think peers are doing it better than us. I mean, I know some private equity firms go into companies and literally just plug into an ERP system and download every piece of data they have, and then go through whatever analysis they think is fruitful or at least productive. And we're not at that stage yet. We have a process that we go through, and we have an operations group that sits alongside us, and we have a predictive analytics professional on that team, and he's certainly a big help. But I think the market is changing, and there are some pretty sophisticated approaches to data that will become more and more common in private equity over the next few years.
Yeah.
That's for sure.
Thanks. Chris, how about you? And then maybe we'll get some comments from Jessica.
I mean, I agree with everything that's been said. It does seem that things are taking longer to get done. Really just the flow of information, just the, I guess it's just a product of this whole situation seems to be a little more slow. But the process really hasn't changed all that much. And like, my panel, we are definitely meeting management in person and going to the facilities before closing, but we're doing a lot of Zoom up front with them and trying to time that way. But the act of getting to the facility, and we still think it's important to break some bread with people before starting a 4 or 5 year relationship support.
I miss those days. Jess, you want to go ahead?
Yeah, no, I mean, not a whole lot new to add. It seems like things are taking a long time. It does feel like in some cases, we might see a overall process change, kind of an initial virtual meeting before the facility visit. So, we've talked internally if bankers would start using kind of a virtual setup as a way to, tighten the field. So, maybe you do 15 virtual meetings and then narrow to 5 in-person visits or something like that. So that's kind of something we've talked about. We do a good deal of proprietary sourcing here at LFM. So direct to owner, outreach and then direct to owner, diligence processes. And I would say those take a long time anyway, but man, oh man, those have been gruelingly with a whole lot of business distraction with COVID and then trying to get deals done. So we as we near closing a deal like I just described, we're very thankful for people like John who help hold owners' hands through these processes.
Excellent. Maybe I'll just put one other question to the group, and it's a little political in nature. So if you don't want to answer, I won't push it on you. But I love manufacturing, the resiliency of it over the years. I've worked with manufacturing companies my whole year, and it just seems to be a resilient industry. And when you overlay technology and robotics and more automation, it just seems like it's unstoppable in so many ways. But does with the changing of the administration, does anyone have a view on how that might impact the outlook over what will be the next 5-year holding period, shifting? Jessica, you're nodding. You want to take that one?
Well, so I think a lot depends on what happens in early January with the Georgia runoff, and if we see any changes that could impact tax planning, that could certainly have a major impact. But that would be across all industries. Manufacturing perspective, we feel pretty good about reshoring, as John talked about, and that trend's going to continue. Regardless of who's in the White House, we feel pretty good about automation and things like that as well. So I think that, we think that small, manufacturing companies are the backbone of the U.S. economy, and we don't think that's going to change. So we're okay either way.
Excellent. Anyone else want to chime in on what might happen with changing? Okay, that's fine.
I will say though that and this isn't really political, but I think that as we emerge in 2021, manufacturing is going to come out of this a lot stronger. I don't know if any of you saw the article in the Journal the other day that talked about the bottom of manufacturing. And this COVID situation, I really do believe it has caused people to rethink their supply chains and not only the reshoring, but diversification thereof. And I think all of that is just going to be very good for American manufacturing.
Excellent. Well, I think we covered the material we wanted to cover. I didn't see other questions from the audience. Lena, I'm not sure if there's any other follow-ups, but other than appreciation and thank you, this has been a great panel, not only to participate in, but also to learn from. I've got 2 pages of notes here that I scribbled down during the course of the presentation. So is there any other follow-ups, Lena?
You know, we have a couple follow-ups. If anyone wants to ask a last minute question, feel free. But definitely want to thank all of you. John, thank you for leading the way, and to our panelists for all your contributions along the way. Thank you to our audience for attending what is our last webinar of 2020. Not to worry, many more to come, but we appreciate you hanging in with us and joining us today. For those of you who are participating in the one-on-one Deal Connect meetings, you're going to want to log out of this link and log into the separate link that my colleague Terrence Winters circulated yesterday. Any questions, please reach out. We'll be in touch with updates. We will be posting this recording to our YouTube, so look out for that as well. But until the next time, happy holidays to everyone. Stay healthy, and we'll see you all soon. Thanks, everyone.
Thank you.
Bye now.
Appreciate it.
Merry Christmas, Sal.